The Little Book of Common Sense Investing by John C. Bogle, a WealthWorks summary. Introduction. The man who changed investing forever. In 1976, John Bogle did something the investment industry considered absurd. He launched the world's first index fund for individual investors. It was mocked, called Bogle's folly. The idea that you could simply buy the entire market, every stock, in proportion, and outperform most professional money managers seemed laughable to an industry built on the promise of stock-picking expertise. Half a century later, index funds hold trillions of dollars and have demonstrably outperformed the vast majority of actively managed funds over almost every meaningful time period. Bogle was right. The industry was wrong. And the Little Book of Common Sense Investing is his definitive explanation of why. Bogle's argument is ruthlessly simple. In investing, you get what you don't pay for. The stock market generates a return. Every dollar paid in fees, commissions, and expenses reduces that return. The investor who minimizes costs keeps the most of what the market gives. And the single best way to minimize costs while capturing the full market return is to own the entire market through a low-cost index fund. This is not a complicated book. Bogle did not want it to be. He believed the most important truths in investing are simple, and that the investment industry profits enormously from making them seem complicated. Strip away the complexity, and what remains is this: buy everything, pay almost nothing, and hold forever. Chapter 1: The Winning Formula. Own the market, pay nothing. The stock market as a whole generates a return. Call it the gross market return. Every year, that return is divided among all investors. But before investors receive their share, a large portion is taken out in the form of fees, expenses, trading costs, and advisor commissions. What remains is the net market return, what investors actually keep. Here is Bogle's central insight. All investors together own the entire market. Their collective gross return must equal the market's gross return, but their collective net return, after costs, must be less than the market's gross return. It is a mathematical certainty. The average active investor must underperform the market average by exactly the amount of their costs. This means that active management, as an industry, is guaranteed to underperform passive investing over time. Some individual managers will beat the market, but for every manager who outperforms, another must underperform by the same amount. The net result for all active investors together is the market return minus their collective costs, and those costs are very large. The solution is to own the market rather than try to beat it. An index fund that holds every stock in proportion to its market value, charging minimal fees, will capture almost the full market return. Over time, that small difference in cost compounds into an enormous difference in wealth. The action: calculate the total annual fees of your current investments. Include fund expense ratios, advisor fees, trading commissions, and any platform charges. Every percentage point you pay in fees is a percentage point of return you are permanently surrendering. Chapter 2: The Tyranny of Compounding Costs. Bogle is obsessed with costs, and for good reason. The effect of even small annual cost differences over long investment periods is shocking. Consider two investors, each starting with $10,000 and earning the same gross return of 7% per year. Investor A owns an index fund charging 0.1% per year. Investor B owns an actively managed fund charging 1.5% per year, a modest charge by industry standards. After 40 years, Investor A has approximately $150,000. Investor B has approximately $100,000. The same markets, the same starting capital, a $50,000 difference, simply from costs. Now consider that most actively managed funds charge more than 1.5% when all costs are included, and most fail to generate enough excess return to justify those costs. Investor B would need to significantly and consistently outperform the market just to break even with Investor A after costs. Bogle called this the cost matters hypothesis. a deliberate contrast with the efficient market hypothesis of academic finance. He did not need to argue about whether markets were perfectly efficient. He only needed to observe that costs are real, certain, and permanent, while outperformance is uncertain, unreliable, and tends to disappear over time. The action: look up the expense ratio of every fund you own. A reasonable expense ratio for an index fund is below 0.2%. If you are paying more than 1% in any fund, ask yourself what evidence you have that this fund will outperform by enough to justify the cost. Chapter 3: Why Stock Picking Fails. The evidence. Bogle was not simply making a theoretical argument. He marshaled decades of data to show that active management fails in practice, not just in theory. The evidence is overwhelming. Across almost every time period studied, the majority of actively managed funds underperform their benchmark index after fees. The longer the time period, the worse the active fund record becomes. A fund that outperforms for 5 years has roughly a coin flip chance of outperforming in the next 5. Past performance, as every fund disclaimer correctly states, is not a reliable indicator of future results. Why does active management fail so persistently? Costs are the primary reason, but there is also the problem of the market's collective intelligence. When you buy a stock at a given price, someone is selling it to you at that same price. Both of you believe you are making the right decision. One of you is wrong. And in a market where millions of highly trained, well-resourced professionals are analyzing the same information, the chances of any individual having a consistent informational edge are very small. There are exceptional investors who have beaten the market consistently over long periods, Warren Buffett being the most famous. But they are extraordinarily rare, and identifying them in advance is itself an extremely difficult problem. By the time a fund's strong track record becomes public knowledge, much of its best performance is often already behind it. The action: research your fund manager's track record, not just for 1 or 2 years, but for 10 or 15. Compare the net of fee return to a simple index fund benchmark for the same period. The result will surprise most people. Chapter 4: The Index Fund, the only sensible choice. Bogle's solution is not sophisticated. It is not nuanced. It is not exciting. It is a total stock market index fund, one that holds every publicly traded stock in proportion to its size, rebalances automatically, charges a minimal fee, and requires no active decisions whatsoever. This approach wins not because it is clever, but because it avoids all the ways most investors lose. It avoids the cost drag of active management. It avoids the performance chasing that leads people to buy yesterday's winners and sell yesterday's losers. It avoids the emotional decisions that come from watching a portfolio of individual stocks fluctuate. And it captures the full long-term return of the market, which over decades has been powerfully positive. Bogle's preferred vehicle was the Vanguard Total Stock Market Index Fund, which he created. Today, there are similar products from every major fund provider at costs that would have been unimaginable in 1976. The investor today has access to better, cheaper tools than any generation before them. He was also clear on international diversification, owning a mix of domestic and international stocks, and on including bonds for stability. A simple 3-fund portfolio, domestic stocks, international stocks, and bonds, captures almost all available diversification at minimal cost. The action: if you own actively managed funds, research the equivalent index fund. Calculate the difference in expected long-term wealth based on the fee difference alone. Then decide whether the active fund's track record justifies the cost. Chapter 5: Stay the course, the hardest part. Owning an index fund is simple. Holding it through a market crash is not. No. Bogle understood that the greatest threat to the long-term index investor is not the market. It is themselves. The temptation to sell during a crash, when the portfolio has fallen 30 or 40%, and every headline predicts further disaster, is almost overwhelming. The temptation to shift into bonds or cash when the future feels uncertain is powerful, and the temptation to switch to an exciting new fund or strategy when the index fund seems to be falling behind is ever present. Bogle's response to all of these temptations was the same: stay the course. The index fund works over long time periods. It does not work over every short time period. Market crashes are the price you pay for long-term equity returns. Selling during a crash transforms a temporary paper loss into a permanent real loss. He pointed to the consistent data showing that individual investors earn dramatically less than the funds they own because they buy and sell at the wrong times. The average equity fund earns its stated return over any given period. The average investor in that fund earns less because they add money after good years and withdraw after bad ones. The action: decide in advance what you will do if your portfolio drops 30%. Write it down. The answer should be nothing, or perhaps buy more. Having a written plan for the bad times protects you from the emotions of the bad times. Chapter 6: Bond Funds and Asset Allocation. Bogle devotes significant attention to bonds, and his argument is consistent with Graham's. Bonds serve a different purpose than stocks. They provide stability, income, and a cushion during equity downturns. They are not there to generate maximum growth. They are there to let you sleep at night when stocks are falling. His rule of thumb for bond allocation is simple and memorable. Hold your age in bonds. A 30-year-old holds 30% bonds. A 60-year-old holds 60%. This is approximate. Some investors with strong income and high risk tolerance can hold less. Some approaching retirement with lower tolerance should hold more. But as a starting point, it is remarkably sensible. The logic: as you age, your investment horizon shortens. A 30% market decline is painful at 30 but recoverable over the following decades. The same decline at 65, when you may need to draw down the portfolio within years, is far more damaging. Bonds do not prevent the decline in your stock holdings, but they provide an asset class that tends to hold its value and can be rebalanced into stocks after a crash. The action: review your current asset allocation. Is the split between stocks and bonds appropriate for your age, your investment horizon, and your psychological tolerance for drawdowns? If not, consider rebalancing toward a more appropriate mix. Chapter 7: The Arithmetic of Loss. Bogle includes a chapter that every investor should read and reread. The Arithmetic of Loss. When your portfolio drops 50%, how much does it need to gain to get back to where it started? Not 50%, 100%. A 50% loss requires a 100% gain to recover. This asymmetry is one of the most important and least understood facts in investing. It explains why avoiding large losses matters as much as, perhaps more than, achieving large gains. An investor who avoids the catastrophic losses by maintaining appropriate diversification, by not concentrating in a single sector or stock, by not using leverage, will often build more wealth over time than an investor who swings for the fences and occasionally hits home runs. The index fund naturally limits catastrophic loss by owning everything. No single company's failure destroys the portfolio. No single sector's collapse is more than a small weight on a broadly diversified position. The investor who owns the whole market can never lose more than the whole market loses, which has always historically eventually recovered. The action: review the concentration in your portfolio. If any single stock, sector, or fund represents more than 10% of your total investments, ask yourself what happens to your financial life if that position drops 80%. If the answer is painful, diversify. Chapter 8: The Simple Portfolio for a Complex World. Bogle's final message is an act of simplicity in a world that profits from complexity. The investment industry is designed to make you feel that you need help, that markets are too complex to navigate without guidance, that the right fund selection requires expertise you do not have, that there is always a better strategy available if only you knew where to look. None of this is true. The investor who owns a simple, low-cost, globally diversified portfolio of index funds, contributes regularly, rebalances annually, and ignores the noise will outperform the vast majority of investors and the vast majority of professional fund managers over any meaningful period. The simplicity is the point. Complexity costs money. Complexity leads to mistakes. Complexity is where the industry extracts value from your portfolio. The simple portfolio has no hidden costs, no complex decisions to make at the wrong time, and no narrative about why this year is different from last year. Bogle spent his career fighting for the individual investor against an industry that had, in his view, misaligned its interests with those of its clients. The Little Book of Common Sense Investing is his clearest and most direct statement of everything he believed. The action. Could you describe your entire investment strategy in one sentence? If not, it may be more complex than it needs to be. Try. I own a globally diversified portfolio of low-cost index funds, contribute regularly, and rebalance annually. Everything else is noise. Key quotes. The stock market is a giant distraction to the business of investing. Don't look for the needle in the haystack, just buy the haystack. In investing, you get what you don't pay for. Time is your friend, impulse is your enemy. The miracle of compounding returns is overwhelmed by the tyranny of compounding costs. How to apply this? Open your investment account and calculate your total annual cost burden, expense ratios, advisor fees, platform charges. Every percentage point matters over decades. If you do not already own index funds, research the total market index funds available through your broker. Look for expense ratios below 0.2%. Vanguard, Fidelity, and BlackRock all offer suitable products in most markets. Set up automatic contributions. Monthly is ideal. Decide on your stock-bond split based on your age and risk tolerance. Set a calendar reminder to rebalance once a year. Then stop. Check your portfolio quarterly at most. Read Bogle's book when you feel the urge to do something clever. The clever thing is to do nothing. Or note at the end. John Bogle died in 2019. In his lifetime, the index fund movement he started had transferred trillions of dollars from the investment industry back into the pockets of ordinary investors. He was genuinely transformative, one of the few people who made the financial system meaningfully fairer. The Little Book of Common Sense Investing is short. It can be read in an afternoon, but the ideas it contains, if followed with consistency and patience, have the power to fundamentally change your financial future. Buy everything. Pay almost nothing. Hold forever. This has been WealthWorks. If this was useful, subscribe. There is more where this came from. Yuri Renouan.